The TJX Companies Inc., NYSE, TJX, stock is currently trading at $145.58, up 40 cents or 0.28% in today's session. Now, the common market expectation, especially with the Q3 earnings call scheduled for 11 a.m. GMT-5 today, was for the stock to be somewhat range-bound or show slight anxiety leading up to the report. That's the baseline expectation. But the reality is that the stock is displaying surprising resilience and positive pre-market momentum, having already printed an intraday high of $146.83, just shy of its 52-week high of $148.11, and that's because the company just dropped its Q3 report this morning, and it's a classic TJX stock beat on the top and bottom line. Specifically, TJX posted earnings per share of $1.28, which handily topped the Zacks consensus estimate of $1.22, and revenue came in at $15.12 billion, comfortably exceeding the $14.9 billion analyst forecast. The unexpected angle here, the thing that is fueling this modest, yet meaningful intraday climb, isn't just the beat, but the underlying performance metric, same-store sales. TJX reported a 5% increase in same-store sales, which is an acceleration from its historical average, and indicates that their core treasure hunt model is resonating more strongly with consumers than even the most optimistic forecasts suggested, especially in an environment where many traditional retailers are struggling with margin compression and sluggish traffic. This performance completely disrupts the standard narrative that off-price retail is merely a cyclical winner, benefiting only from high inflation, forcing lower-income consumers to trade down. The deeper truth is that TJX is taking market share from across the income spectrum, a fact underscored by strong growth in its Marmaxx, TJ Maxx, and Marshalls, and HomeGoods divisions. This is where we need to rethink the popular belief. The general sentiment around TJX stock has long been that it is a solid defensive play, a business built on structural value that performs well when the consumer is squeezed, providing a hedge against macroeconomic uncertainty. It's seen as the anti-retailer, a counter-cyclical winner that benefits when higher-end department stores and even mid-tier retailers have excess inventory they need to liquidate. That expectation is based on a sound business model, but it falls short of capturing the company's full current momentum. The reality is that the stock is now acting less like a defensive trade and more like an offensive growth stock within the battered retail landscape. The key evidence is in the acceleration of customer transactions, not just average ticket size, and the significant margin performance. The pre-tax profit margin came in at 12.5%, essentially flat year over year, but maintaining that margin strength while driving 5% comparable sales growth is a testament to their flexible, opportunistic buying model and disciplined inventory management. This is not just surviving a downturn, this is thriving during a challenging period, something you just don't see from most of its peers in the consumer discretionary sector. The strong performance, especially the sales beat, is driving a surge in volume today, with trading volume significantly above its 3-month daily average. This institutional activity, which often precedes sustained moves, suggests that large individual brokerage accounts and funds that may have been neutral or underweight the stock are now being forced to reevaluate their positions and potentially buy into the strength following the Q3 surprise. Looking closer at the recent stock movement, the stock has been grinding higher, particularly since the beginning of November, recovering nicely from a slight dip in late October. The overall price action has been characterized by higher lows and steady upward momentum, a trend that this morning's earnings report has only served to solidify. The $148.11 52-week high now looks like a highly probable next resistance test. What's driving the price between major earnings reports often comes down to analyst sentiment and institutional rotation. Over the past few weeks, we've seen several major firms like TD Cowen and Jefferies raise their price targets for TJX Companies Inc., citing the off-price strength and execution, with some targets now reaching up to $170. This pre-earnings momentum built an expectation of a solid report, but the 5% comp sales number and the confident guidance are what truly exceeded those already elevated expectations. Institutional ownership is already very high, sitting around 91%, but the specific flow of institutional funds is what matters. The most recent 13F filings show a mixed picture, which is typical, but you see significant increases in holdings from managers like Volaridge Investment Management and Volian Capital Management, indicating a strong institutional conviction in the long-term off-price thesis, particularly as consumers continue to grapple with high costs for housing and other necessities, making them hypersensitive to discretionary spending value. If you've been using platforms like Robinhood or an intelligent portfolio through Fidelity Investments to manage your retail holdings, you've likely seen this strength play out in your own returns over the last year, with TJX stock significantly outpacing the broader S&P 500. The business model of the TJX companies is fundamentally different from traditional retail. They operate TJ Maxx, Marshalls, HomeGoods, HomeSense, and Sierra. They don't follow a traditional retail calendar. Instead, they operate as a flexible sourcing machine. Their buyers, who are essentially market experts, are constantly looking for opportunities to purchase excess inventory, overstocks, and canceled orders from manufacturers and other retailers, often at a discount of 20 to 60% off traditional retail prices. This model creates a treasure hunt experience for the consumer, encouraging frequent, unscheduled visits to stores because the inventory is constantly changing. This high inventory turnover and low stock risk is what makes their financials so robust, especially the inventory turnover ratio, which is significantly better than that of many department stores. The beauty of this model is its built-in resilience against inventory mistakes. If a traditional retailer misjudges a trend, they are stuck with merchandise. If TJX buys wrong, they simply liquidate it at a small discount within their own network, often without significant margin damage. This flexibility, coupled with a vast and highly diverse supplier base, over 21,000 vendors globally, provides a structural hedge that few other retailers can match. In the context of online investment strategy, it's a company that offers a unique value proposition that is difficult to replicate purely in the digital space, as the physical experience is central to its brand. The macroeconomic pressures of the past year, high interest rates, persistent inflation, and the drawdown of excess consumer savings have actually been a tailwind for the off-price sector, and for TJX Companies Inc. in particular. While other retailers talk about inventory bloat as a problem, for TJX it's an opportunity. The current economic climate means more vendors are under pressure to offload goods, which translates to better buying opportunities and higher mark-on for TJX. Furthermore, their appeal is broadening. The consumer is increasingly polarized, with high-end luxury performing well and deep value performing well, leaving the middle vulnerable. TJX sits squarely in the value sweet spot, attracting not only the core bargain shopper, but also higher-income individuals looking to save on quality brand-name goods. This phenomenon is why the 5% comparable sales growth is such a strong indicator. It shows their customer base is growing and spending more frequently. The fact that the growth was driven by customer transactions, more people coming through the doors, is the strongest proof point for the enduring strength of the off-price model. We are seeing a structural shift in consumer behavior where value seeking is no longer stigmatized but normalized across all demographics, and that is a long-term benefit for TJX stock. However, we need to balance this enthusiasm with a look at the challenges, fulfilling the tension between expectation and reality. The market's excitement is tempered slightly by the Q4 revenue guidance, which came in at $16.76 billion at the midpoint, below the $17.31 billion analyst estimate. This guidance is the reality check, suggesting that while the Q3 execution was outstanding, management is being appropriately cautious about the all-important holiday quarter, particularly as it relates to consumer spending fatigue and potential geopolitical uncertainties that can impact supply chains. The stock's modest gain post-announcement, rather than a blowout spike, reflects this slight disappointment on the forward guidance front. Furthermore, the P/E ratio, sitting around 33 times trailing earnings, is high for a traditional retailer. While justified by the company's consistent performance and market-defying growth, it introduces a valuation risk. If TJX Companies Inc. were to miss future earnings expectations or see comparable sales growth slow materially, the stock could face a significant multiple contraction. This is why investors need to keep a close eye on metrics like freight costs and mark-on, which are the main levers for their gross margin. Even the most effective off-price model still operates within a competitive environment alongside rivals like Ross Stores and Burlington, all vying for the same excess inventory and value-conscious consumer. To maintain its authority, TJX must continue to use its scale, the largest in the off-price sector, to secure the best deals from vendors globally. The future outlook for TJX stock remains compelling, primarily because its catalysts are tied to structural advantages and macroeconomic trends that are still in play. One major catalyst is the continued expansion of its store footprint, with the company still targeting over 1,800 additional stores across its existing countries. This organic store growth